Hello and a very warm welcome to this webinar. When the rubber hits the road, bank resolution, unlike supervision, is a murky concept, brought to you by Scope Group. My name is Keith Mullin, and it's my pleasure to be your moderator for today's session. And I'm delighted to be joined today by Sam Theodore, Senior Consultant at Scope Group, with a long track record as a bank credit analyst and former bank regulator. Today's subject is a very topical issue of bank resolution and supervision, as I say. This is always very much in focus, but perhaps particularly so this year, given the banking turmoil earlier this year in the US and Europe, and the renewed focus on resolution tools and supervisory action. Sam will be arguing today, amongst other things, that the prompt and unconditional takeover of a stressed bank by a healthy peer should be the only effective endgame of bank resolution. Sam is going to, in a moment, outline his thoughts. After that, he'll be delighted to take your questions. So please do type these into the questions tab as we go along. Before I hand over, I also just wanted to draw your attention to Sam's regular opinion column entitled The Wide Angle, which covers a range of current European banking topics, including today's subject. I do commend these to you. They're always a great read and are freely available on the Scope Ratings website. So that's it from me. Sam, good afternoon. Great to see you. Let me hand over to you.
Thanks, Keith. Thanks, everybody, for being here. Good morning or good afternoon, wherever you are. So basically, the question is, why discuss resolution now when only yesterday the EBA published the results of its transparency exercise, which shows that European banks, at least those in the European Union, are in root health with strong capital levels, improved profitability, high ROEs, basically manageable asset quality, surprisingly so. So why worry about resolution? Well, because I think that this is the right time to make sure that if and when the resolution process will happen on some banks, the process is properly managed and it's credible. And this is where I have some doubts, and I'll try to explain them in this short presentation. I think not surprisingly, supervisors and bank regulators in general are in a festive mood. Now at the end of the year, they point to job well done on the supervisory front, which is true. I think that good and proper supervision is one of the key drivers of the strong financial condition of the sector. Now at the end of 2023, something which is often overlooked by market participants, investors and analysts. Not most of the time, investors, when that's the case, praise bank management for adopting good strategies or pushing for higher revenues. But very often the people in the shadow who actually are steering bank strategies through a constant dialogue with bank managers are the supervisors. And actually the supervisors have tremendous powers in Europe, well beyond looking for the prudential metrics on capital, leverage, and liquidity. And that's why I believe that that supervision is or should be viewed as the last line of defense, external line of defense for against the bank failing. And that's very important, because once it gets to resolution, then all bets are off. Now, when it comes to supervisory tools, there are a lot of them, and not all of them are currently used. So first and foremost, you can continue the supervision process for a failing bank through early intervention, which is all in the power of supervisors, changes of management, changes or discontinuation of business lines, going all the way to forcing a conversion of AT1 securities, if the point of non-viability, quantitative or supervisory, is being reached. So supervisors have a lot of tools at their disposal to prevent the bank from collapsing, even without going all the way to resolution. Now, if you have to go to resolution, then, as I said earlier, bets are off. If you look at the framework itself, the BRRD adopted some 10 years ago, it's an intellectually compelling framework, which makes a lot of sense. And following the adoption of BRRD, supervisors and resolution authorities have organized over the years joint colleges, crisis management exercises in which they involve the banks themselves. And all these things are unmistakably positive, contributing to more regulatory discipline for bank management. But at the same time, I believe that when the rubber hits the road, as they say, this is not going to work if the resolution authorities believe that the bank in resolution at the end of the process will end up being on an independent basis a going concern and continuing its activities through recapitalization and other steps. I really don't believe that's a viable line of thinking, simply because of a very likely fast bank run well before this resolution process goes into effect. So we have to look no further than what happened last spring in the US with SVB and in Switzerland with Credit Suisse. So in this day and age, a bank run is not manifested like, if some of you remember, the long queues of customers in front of a Northern Rock Building Society branch in August 2007, which was filmed by a BBC cameraman. In this day and age, bank runs take place digitally. I tested myself how fast it's to move from one bank to another. It's extremely, extremely simple. You even have websites and applications which facilitate the process. And in 5-10 minutes, you can be the client of a new bank, leaving the weak bank behind. So these digital runs can happen very fast, following bad news about specific banks spread through social media, as we all know. So I think that the thinking on the resolution process with step 1, 2, and 3, and 4 needs to be rethought. And that's what leads me to believe that the only viable outcome of resolution, which is credible, is the forced merger or takeover of the failing bank by a financially stronger peer, ideally in its domestic market. Why in its domestic market? Because a forced takeover of a weak institution usually entails painful decisions, not least getting rid of a lot of staff. So if this is done by a foreign bank, political and other type of even nationalistic reasons or arguments will be raised, and the process will be polluted by politics. Let's take the very theoretical example of, say, a large French bank about failing or about to fail. Would we really expect that a forced merger would be imposed with a stronger Dutch bank or Spanish bank or Italian bank rather than a French domestic bank? I don't believe that, single market or not. So I think we shouldn't exaggerate too much the benefits, the integration in the single market, because at the end of the day, retail and commercial banking is still a national affair. Many years ago, when UniCredit merged or bought a large German bank in Bavaria, well, the Bavarian clients of that bank are still banking with the Bavarian bank, not with UniCredit in Italy. So the banking still remains a national affair, single market or not. So if that's the case, I think that the most likely scenario will be that of a large domestic bank taking over the weak bank. And indeed, this is what happened in Switzerland, which of course is not part of the EU. But let's not fool ourselves that if a large French bank is about to collapse, the French government is going to remain passive and wait for the outcome of the deliberation between the ECB and the Single Resolution Board in Brussels, and at the end of the day see where that leads them, because that's not going to be the case. In the case of Credit Suisse, which is a very interesting case, based on the details coming out of the recent report by the Financial Stability Board, resolution plans for Credit Suisse were in place since 2022, which included the total bail-in of all bail-inable debt of Credit Suisse, including senior non-preferred. But when the crunch time came, the resolution plan would have been debt is bailed in, and on Monday morning, Credit Suisse opens up with a CET1 of 44%. Of course, that didn't happen. The Swiss government, and rightly so, preferred the non-resolution option of forcing a merger through an emergency decree, which prevented the shareholders of either bank from vetoing it. And that was not as part of the resolution. Why? Because the government believed that to bail in such a massive amount of bail-inable debt, tens of billions of Swiss francs and euros and dollars, would create a significant market turmoil and instability, and rightly so. We can see what happens when, in the case of a bank not making payments on AT1, the whole AT1 market is being repriced, at least for a while, and issuance is becoming more difficult, at least for a few months. Now imagine AT1 market being a small market compared to the much bigger market of senior debt, including non-preferred. If you'd have a large bank bailing in non-preferred senior debt, you can imagine that the whole debt market for banks would freeze or collapse or things of the sort, which obviously would be the opposite effect of what the resolution framework wanted to accomplish. And that's why it's very important to bear in mind the practicalities of this framework, not really going only through the intellectual process, which in theory can work very well. Now, that brings into question the issue of state support, because it's difficult to undertake such a massive merger without some elements of state support, which indeed happened in the case of Credit Suisse, especially when it's an example of state support which doesn't entail using taxpayer money upfront. So the government providing liquidity, an emergency liquidity line, or the government providing second loss guarantee, which was the case with Credit Suisse, and subsequently this second loss guarantee was withdrawn because there was no need for it. So I think that ideologically, we don't want to think about state support, because then that takes us back to too big to fail, to the pre-great financial crisis situations. I think that we cannot be ideologically too rigid, and we have to accept that in this day and age, when it comes to large organizations like a mega bank, some elements of state support have to be contemplated to make this merger, this consolidation, palatable. So that's a very important point to make. Now, if that's the case, I think that the banking authorities should try to point to the need of a merger as a key element of resolution rather than pointing to the scenario of the bank continuing as an independent entity. Which brings me to a parenthesis on CMDI, the crisis management and deposit insurance reform now being contemplated, proposed by the European Commission, I think, which is going to be adopted. In the main, it's a very positive development because basically it includes non-guaranteed depositors in the depositor preference, which is a normal thing given that depositors have a different goal when they put their money in the bank versus investors which are looking for risk return advantages. So CMDI is good from a depositor preference angle, but if one expects the deposit guarantee scheme to be used in bail-in, I think one is mistaken, because I don't think any bank will get to a stage where you burn through all the other bail-inable debt, get all the way to the DGS, to the deposit guarantee scheme, to be bailed in, and the bank still continue to exist. A bank run would have occurred on that bank long before that. So if that's the case, then the question is, well, why is the market making a difference between senior preferred and senior non-preferred? And that's a very good question. Arguably, rating agencies are making a difference in their rating notching, so they should. But at the same time, I think that when the crunch time comes, a large bank, we are not going to see non-preferred debt being bailed in a resolution scenario. Other things will occur well before that, because when it comes to bailing in senior debt, I don't think that bank is in any position to continue its existence. That's why I believe that if I were an investor, I would find non-preferred debt very attractive from a risk-return angle. So just to conclude, the three key points here. One, that I believe that it's supervision, which is the most credible last line of defense for a failing bank rather than resolution. Two, that I see resolution only through a forced merger with a financially healthy peer, preferably domestic. And three, the attractiveness of non-preferred senior debt issued by banks, which is to some extent still disputed in the market by some. I'll close here and hopefully you'll have some questions. Thank you.
Good, thank you very much for that, Sam. Some very insightful food for thought there. There is actually one question, which I hope you can still hear me, because I think I've lost you on video. But the question is about deposit insurance. And the question is this: might forward-looking, risk-sensitive deposit insurance premiums lead to quicker management action to arrest a bank's deteriorating condition than relying on external bank supervision for such corrective actions?
Well, deposit insurance, I think it's the premium paid by banks for deposit insurance varied according to the internal rating that the bank is being given within the system. I think for a very risky bank, they would have to pay more for deposit insurance than a less risky bank. But at the same time, again, the risk is outside of deposit insurance. Deposit insurance goes all the way up to 100,000 euros in Europe, 85,000 pounds in the UK. So the risk is really beyond that. So what happens to the bank that insure depositors? If I have 50,000 euros in a bank, I'm fairly confident I'm going to get my money back if the bank collapses, not today, not tomorrow, but maybe in a few days, in a few weeks. What happens if I have 500,000 or if I'm an investor in that bank? So that's where the issue is to me, more than within the deposit insurance scheme itself.
Okay.
I'm not sure if I answered the question, but that's something that I try to put together.
All right. There's a follow-up question, Sam, on deposit. Why do you expect depositor preference to go through despite some countries' opposition? I'm not sure if you have a thought on that.
Yeah, I'm not sure that it's going to. I hope it's going to go through. I think it's going to go through, but I cannot be sure because, as you say, there is some opposition. I think it makes a lot of sense, especially in light of what happened last spring with SVB, and also with Credit Suisse. Although in the case of Credit Suisse, it's not so much the depositors, but the customer funds in private banking which walked away from the bank. But I think that to extend the depositor preference to non-insured depositors makes a lot of sense. What would also make a lot of sense, but I don't think it's going to happen, unfortunately, is for the deposit insurance ceiling to be raised. It's currently at 100,000 euros. In the US, it's $250,000. And the Congress is talking, or was talking until recently, about raising that ceiling even more. I think, and in the UK, Bank of England is also contemplating perhaps raising the ceiling from £85,000. So I think that we should, ideally, we should see a higher deposit insurance ceiling per depositor, which of course is not going to be easy because that would mean that banks would need to be more in premium for that. But again, that's the price of doing business in a safe way.
Okay, thanks, Sam. Then following up, referencing your comments on senior non-preferred debt, there's a question here on your view. What's your view on MREL eligible senior preferred debt? Do you see it being used?
No, I think in general, the MREL concept, I mean, at the beginning, years ago, everybody was extremely enthusiastic about the TLAC first and then MREL in Europe. And they thought finally the uncertainty in banking of a bank collapse is being put to rest because with so much of an MREL cushion, the market will be able to pay for the bank collapse and not the taxpayers. But that was very simplistic, and we didn't realize that, now banks, they all comply or about to comply by the end of the year with the MREL amounts. But the question is this MREL going to be actually bailed in? And as I try to argue during the presentation, I don't think so. I mean, just imagine a large European bank having to burn through its liabilities all the way to through all its non-preferred debt. Well, what's left there to be able to get to the preferred? I think that by that stage, the bank is no longer going to exist. So all this discussion is purely theoretical. And we all know that when the rubber hits the road, that bank is no longer going to exist. Many steps before that.
Yeah. No, indeed. And perhaps a much more high-level question. This notion of effectively a forced or negotiated takeover with state support, this goes against the orthodoxy that has been in place since 2008-9, in fact, in the re-regulatory post-global financial crisis phase. Is your sense that the thinking within regulatory and policy-making circles has just moved on from this incredibly strict, no taxpayer dollars on the line to bail out fat cat bankers. Do you sense that narrative has moved on?
No, I don't think so. I think that regulators, supervisors, and if you look at all these speeches given by senior supervisors in Europe, they still focus on the market preference, and they totally exclude the taxpayer preference. And I agree with the general lines of this discourse, but at the same time, not all state support, as you know, the case of Credit Suisse showed, not all state support needs to be immediately translated into using taxpayers' money. When you have a second loss guarantee, which is not likely to be used, or when you provide an emergency liquidity support, which is going to be there to make sure that the bank will continue as a viable entity, which was the case as within, you know, after the merger, you don't have to conclude necessarily that taxpayer money will be lost, will be spent. And at the end of the day, it's not the bank regulators, the banking authorities, which are going to change the discourse. But when, again, the crunch time comes, when a large bank in a country is about to collapse, the government of the country will intervene, as we saw in Italy with Monte dei Paschi, and obviously in Switzerland. But I have no reason to believe that would not be the case in a country like France, like the Netherlands, like Spain, like any other large West European country. So that's where I expect the non-orthodoxy to come to the fore, especially given the political situation now, where you have more nationalistic trends in local national politics.
Yes, absolutely. Sam, there's a question here about AT1. Now, you referenced that a little bit in your presentation, and you referenced the fact that in the immediate aftermath of the Credit Suisse takeover, there was a closure and repricing of the AT1 market. Now, it's fair to say that with some time having elapsed, the market came back and we saw some national champions able to raise relatively cost-effective AT1 capital, even with the higher bond yields we have at play.
Yeah.
But of course, the narrative was about the Swiss authorities had upended the creditor hierarchy, and this caused a sharp intake of breath. So long question, but the short version is: do you have any view on the future of AT1 as a debt class?
Yeah, again, that's indeed. I mean, I see this question coming very often in the market and in the dialogue that people are having. Based on what I understand from regulators, there's no interest, there's no plan to alter the AT1 structure. So AT1s will continue to be considered as capital instruments. I think that what happened in Switzerland was unfortunate, not because AT1 was written off, but because shareholders were not written off before it. But again, that happened in Switzerland. I don't think it's going to happen necessarily in all other cases in the future if such cases rise. But also in Switzerland, you have this specificity that AT1s could not be converted into equity. They had to be written off permanently. So obviously, if you don't have that, if you have a temporary write-off or a conversion into equity, that changes things. And I think that's where we should see more cohesiveness in the treatment of AT1s in a situation of point of non-viability situation. But AT1s, I think, will remain as debt instruments in capital markets, and banks will continue to issue them. And actually, now, if you look at them, as you rightly say, Keith, there's high demand for that.
Yes, indeed. I guess it's worth adding that one or two banks have indeed actually sought shareholder approval to introduce equity conversion from the right down, right up structures. Another, I guess, sort of high level question, Sam, if I may. This notion of a weak bank or a bank in distress being pulled into a negotiated takeover with a financially stronger peer works in, I guess, systems which have at least, or by definition, one other financially stronger peer. That may not be the case in all jurisdictions. So what happens? I guess your conclusion would be, well, if there's no financially stronger bank, then other tools, move in. But can you perhaps answer this question about, but also perhaps recap on your thoughts about, does your negotiated takeover extend to foreign banks or banks outside the jurisdiction of the bank in distress?
Well, I think that if you talk about a large bank in France or a large bank in Spain or Italy, yeah, that would be the case. But let's say you have a large bank in Slovenia, which is about to collapse, and that bank is independent, not owned by anybody else. Could something like a merger into a foreign bank be contemplated? Of course, because that hypothetical bank in Slovenia would be a small size compared to a large West European bank. So yeah, that thing could happen, did happen in the past, not necessarily through a resolution. But I'm talking more about the national champions in large economies in Europe. I mean, that's going to be, and that's why, again, the first point I was making, very important point, is that the last line of defense is supervision. And take the example of Credit Suisse and Deutsche Bank. So Credit Suisse, we all know what happened. Supervision perhaps was suboptimal in handling this difficult situation by FINMA. Deutsche Bank a few years back had perhaps similar problems of credibility in the market. A lot of people, investors, thought this bank is not going to survive. It's a deep outlier in the broader European banking landscape. And yet the bank managed to pull back and to rebalance. It's not among the best European banks, but it's nevertheless no longer an outlier. And people gave credit to management for that, but I think credit should also go to the ECB supervisors, which behind the curtain did a very good job in steering this bank away from the abyss. When it comes to the nothing else works and this bank needs to be merged into another peer, yeah, I think that the primary preference will for the national government, which is going to be handling that, because I think, again, that's not going to be the stage where the SRB is going to be the sole handler of this process, but rather the national governments, which are voted in power to handle such national emergencies. They will have a preference for a national bank. Otherwise, they could run into political problems. Imagine that a foreign bank will say, well, 30% of the staff of this failing bank needs to go so that the bank becomes viable again. If a domestic peer says that, it's one thing. If a foreign bank says that, it's another thing.
Yes, indeed. And Sam, look, just one more question I want to ask you. There's nothing more lined up. So, at the very beginning of your comments, and indeed referencing previous wide angles that you've written, and this is about resolution, but your contention is that banks in Europe as a whole are about as far away from resolution as they've been for some time. In other words, they're pretty robust from certainly a capital and liquidity perspective. Is that still your, going into the end of 2023, is that your takeaway as well in terms of the strength of the European banking sector?
Yeah, again, absolutely. I mean, look no further than the results of the EBA transparency exercise, which showed that banks are well capitalized, are much more profitable than before because double-digit ROEs on average, on balance, which is relatively good. It's not perfect, but it's good. And still, the asset quality problems, which a lot of people expected to occur, did not occur. Are they going to get worse next year? I think so, but not massively so, and not to a level where one could talk about a crisis. I think we all should expect banks' asset quality to be today better, tomorrow less good. That's a normal cycle of doing business, especially on the commercial real estate side, which actually was flagged by the EBA in yesterday's announcement. But at the same time, I don't think we are going to see anything resembling a crisis next year.
Okay, that could be famous last words, Sam, but well, let's leave it there. I'd like to thank you so much for your very insightful comments, and pretty robust as well, pushing back again to say the accepted orthodoxy. Very refreshing to hear that. Thank you to our viewers for watching and staying till the end. I hope you found that useful. So this is our last banking webinar of 2023. In 2024, we'll be back with more of these sessions, and so do stay tuned for updates. And please do look out for Sam's The Wide Angle comments on European banking and related topics, including CBDCs and digitalization generally. They're a great read. So I wish you a very successful rest of the day, and we'll be back in touch soon. So it's goodbye from us.